Chapter 12, Cost of Capital. So we're going to learn about equity cost of capital and debt cost of capital. So equity cost of capital can be found out using the CAPM equation that we saw in the previous videos. So if you have not seen that video, I highly encourage to go through that video because it's quite important to understand how capital asset pricing model equation works, how we derive the security market line, because that's going to be building on the foundation. But to quickly recap, we capital asset pricing model equation, the security market line equation states that the return that you expect from an investment or your cost of capital, it's the same term. RI is cost of capital, or the return that an investor expects, is equal to risk-free rate plus beta of that investment times the expected market return minus the risk-free rate. So this equation is the CAPM equation. This equation is the security market line equation. This helps us with finding out the cost of capital. So why are we doing this? We do this because we want to find out, hey, is this investment a good investment? And the way we do that is by calculating an NPV. But NPV depends on your future cash flows, right? And those future cash flows have to be discounted. So what discount rate do you use? That's the cost of capital. So this is how it's connected. If you really want to understand NPV, you need to find out cost of capital. And how do you find out cost of capital? You need to know the beta of the investment, and that is basically the risk. So once you know the risk, you know the beta, you can find out the cost of capital, which is the discount rate that you can discount your future cash flows to actually find out the NPV of a project. So that's how all of these chapters are connected. So highly encourage you to go through other videos if you didn't understand this flows. But in a sense, CAPM equation, or the security market line equation, helps us to understand the cost of capital. And basically the risk-free rate is, you can assume the 10-year or the 30-year treasury bond yields to be your risk-free return based on how long you're trying to borrow or invest. Beta is basically you want to find out for this new investment, what is its beta with respect to the market portfolio. So typically beta calculations happen, and there's a separate video that I've posted also for beta calculation. That is chapter 11. So typically the best practice is to use 2.5 years of monthly data in case of equity to find out beta. So that's how you calculate beta. And beta typically is stable for an industry or for a company. So you can actually reliably use beta. So we know risk-free rate, we know how to calculate beta, and we also know how to calculate returns for market portfolio. A market portfolio example would be S&P 500, which has the top 500 stocks in the United States, or Wilshire 5000, or any index fund is basically a proxy for market portfolio. So you can look at their historical data, and you can find out whether their expected return. Be very careful to also add to that expected return the standard error, because that expected return of a market return for S&P 500, let's say it's 8%, but it has a plus or minus 3% standard deviation. So standard error. So you want to find out what is the return for the market that's expected. So that are the subsections of each of this formula. So once you know each of these, you can actually find out for a given investment, is this a good investment or a bad investment? All right, so let's take an example to make it all concrete. So let's say we have eBay and we have UPS. And we want to find out which stock is a risky stock, eBay stock or a UPS stock. So we know from historical data that volatility of eBay is 30%, UPS is 35%. And beta of eBay, which we have covered in the previous videos, an example of that is 1.45 and UPS is 0.79. So the question is, which stock is a more riskier stock? What would you say? Well, volatility is the measure of risk. So higher the volatility, higher the risk. So I would say UPS is a more risky stock. But we also know that beta captures one part of volatility, which is the systemic risk. And volatility has two risks. The systemic risk which is the market risk, and it also has the diversifiable risk, right? So beta captures the systemic risk. So beta and systemic risk plus diversifiable risk equals volatility, right? So beta is part of volatility. So if I were to ask you another question, which stock based on these information is more riskier from a diversification standpoint? I would say eBay is more riskier, right? Because you can diversify the volatility that you get in UPS by combining it with some other efficient frontier portfolio that we covered in the previous videos. But you can't really get rid of the systemic risk of 1.45, which is almost half in UPS. So UPS has higher volatility, so it is more risky. And we can also calculate what's the rate of return that's expected from eBay, right? And we'll get into that. But basically, volatility is systemic risk plus company specific risk. Beta equals systemic risk. So if we were to do that, and volatility equals total risk. So from a total risk standpoint, more volatility, it's worse. But from a diversifiable risk standpoint, I would say eBay is higher in terms of market risk, right? Because you cannot, it's beta or its movement with the market is, if a market goes up by 1%, eBay goes by 1.45%. So its market risk is much higher and you cannot diversify it. So eBay as a company alone has much higher risk. So now let's look at like expected return, right? With these beta and volatility, what does the market expect eBay to return? So we know through the CAPM formula that we just went through above that cost of capital equals risk-free rate, beta times market return minus risk-free rate. So 3% is we have given 3% as the risk-free rate. We know the market returns 8% and eBay beta is 1.45. So if we do that, we get the investors expect 10.25% from eBay with these numbers. The same investor expect for the same investment from UPS 6.95%. So equity cost of capital basically is you can use CAPM to find out equity cost of capital. It basically says the investor expects 10.25% from raising money in eBay from if it was a fully equity funded project with the volatility and beta given here, versus it will only expect 6.95% from UPS if it was a fully equity funded project. And here's the reason why. Because beta in eBay is higher, so it cannot diversify this risk. So that's the main reason. Let's go to the next section. To quickly recap beta, so if you were to plot on the x-axis S&P 500 excess returns over, let's say, eBay returns on the y-axis. So if eBay were to return higher, then you will have a plot somewhere here versus S&P 500 lower. So if you were to plot when did eBay perform better compared to S&P 500, you'll get a scatter plot. And if you do a linear regression, which is basically a statistical technique to plot the best fit line, you'll get a line like this. And when you get this line, the y-intercept is the alpha, and the slope of this line is beta. So beta is basically slope of the best fitting line for the excess return for a given security versus the market return. So the way to think about this is how volatile is this undiversifiable market risk of the company. Okay, so another simple way to understand beta is, let's say if beta of eBay, right? So we are looking at eBay here. So if beta of eBay will be high if eBay has issues when the economy has issues. So when the economy is down and eBay is down much more, then beta is going to be high. Basically, if your company products and goods and services are dependent on how good the economy is, then you will have high beta. But if you're not having that strong dependency, let's say baby milk powder, Nestle will never have issues independent of the economy. Babies will be fed, right? So their economy, their company performance or their beta is going to be much lower than 1 because their demand is quite predictable. So predictable demand, lower beta, market risk related demand, higher beta, right? So we've covered this extensively in previous videos, but understanding beta is important because that's a fundamental part of the CAPM equation. So we've looked at equity cost of capital. Now let's look at debt cost of capital, because that's the second part of this video. So debt cost of capital can be found out using this formula, RD, which is the rate of return that an investor expects from a debt type investment, would be 1 minus P times Y plus P Y minus L, where P is the probability of a default. So in case of debt, default risks come into play, and Y is the maturity of the promised yield that you have at maturity of this debt, and P is the probability of default, and L is the loss rate, like what if for every dollar of debt investment, what is the loss expected. So in a sense, RD equals Y minus PL. So if you know what the maturity of this debt is, because you've invested in that debt, and you know the probability of failure, and if you know the loss rate, then you can find out what is the minimum yield that the investors would expect from this investment. And so the other way to look at this is you can also, if you might have probability of defaults, and so you can even find out, like, equal for a given debt investment, it would have rating. There are rating agencies that give you rating. So there's a probability for what percentage of these debt of this rating types have defaults, or AAAs have like 0% default rate, triple Bs have 0.5%. So there are rating agencies like Moody's and others, they'll publish these probabilities, and you know that average any kind of unsecured debt has a 60%. So if you of loss rates, so if you combine that L 60.6 or 60% and P with the probability of the debt that you're issuing, and you know the yield, then you can actually find out what the debt cost of capital is, which is what is the investor expecting when they are raising money through debt. Alternatively, you can use CAPM as well for debt cost of capital, which is RF, which is a risk-free rate, beta of the debt. So you then either need to know the probability or you need to know the beta of the debt, which these are also published. So beta of certain securities are published. So when you know the beta, you can also calculate RD from beta. So either you need to know the probability or you need to know the beta to find out the debt cost of capital. So the key understanding is that if someone is giving you a 20% yield to maturity, but the RD equation tells you that, hey, the cost of capital, debt cost of capital is 4%. That means that this is a very risky debt, because it should only expect 4%, the minimum debt cost of capital, but they're giving you 20%. That means that there's a high risk of default. They're giving you higher yield to maturity. So if offered a yield that is way higher than RD, then there's a more risk. So that's the key insight intuitively to understand debt cost of capital. All right, so let's take an example again to make it all real. So cost of debt, right? If you want to calculate cost of debt on a given project, let's say you have a 6-year bond yield at 6% with a B rating, and you have an investment that is similar to that, and risk rate is 1%, and market risk premium for this investment is 5%. So if you want to find out debt cost of capital, you do RD equals Y minus PL. So we know Y is 6%, maturity, probability of failure is 5.5%. For the B rating bond that's published by the rating agencies, and there's a 60% loss rate. So you know that, hey, this investment should get at least 2.7%. Alternatively, using CAPM, you can do RF plus beta times the maturity, and they'll give you something similar. As you can see very quickly that you got two different answers here, one using CAPM and one using probability of failure. And the key insight here is that there are multiple ways, and each of these numbers have some sort of a standard error around it, right? So even like when they publish these betas, or even when they publish these probabilities, so any percentage yield would have a plus and minus. So expected return is the key thing to look at. Is expected, they are giving you 6%, but the expected return is 2.7, so they're giving you way higher yield. So there's some risk associated with this, right? And this gives you a ballpark estimate. So it's not perfect, but it gives you a really good ballpark estimate as to what is the cost of debt that you expect. And the higher the difference, that's where the risk comes in. Now let's look at you have a combination, like a given asset or a given project can be financed using debt or equity or both, right? So for a given company that's any company typically has some sort of debt and some sort of equity, right? So a typical project will be financed by a company that has some debt already. So then how do you find out return expectation? So the way you find out the cost of capital is we call this unlevered cost of capital or asset cost of capital. These are all different terms, but they are the same. The way you do that is you find out what the percentage of debt is, what's the percentage of equity, and then you just weight them. So return expectation of an asset, RU, right, or RV is this enterprise, right, or the asset. There are different terms, but RU is basically equity upon equity plus debt times return expectation of equity, debt over equity plus debt over return expectation of cost of capital for debt and cost of capital for equity, right? So once you combine them based on the weight of equity that you're using, weight of debt you're using, you can actually find out the unlevered cost of capital. Similarly, you can find out unlevered beta of this investment. So with the same equity weight for beta of equity and debt weight for beta of debt. So once you do that, you can find out unlevered beta or asset beta. Once you know the asset beta, and typically you use this when you have a combination. And typically all companies, when they want to invest or they want to raise money, they will have some sort of debt and some sort of equity on their balance sheet. So that's what I'm covering here. Project can be financed through equity or debt, and depending on how it's financed, you use the weight accordingly, right? And the key thing to remember is that every beta here is different for the industry and different for the company, different for the project within the company. It's very different. So the way you do that, and if you add taxes to this, all you do is you just add the tax rate at the end. That impacts the debt, and it doesn't impact equity because debt. If you have debt and if you have interest that you pay on that debt, then that is tax deductible. So all you do is you do 1 minus tau, which is basically tau is the tax rate. So if you're 30%, then you just subtract that. So you could imagine that the return expectation will become lower if you're going to use the tax rate. So if you do this and you go from unlevered cost of capital to including the tax rate, then you get the WACC, which is the weighted average cost of capital. These are fancy terms, but it's basically the same thing. If you look at this, it's just adding some layer of complexity on top. Unlevered cost of capital is basically our asset cost of capital, and weighted average cost of capital is basically unlevered cost of capital adjusted for tax benefit that you get. Yeah. All right, so let's make it real again with an example. So let's say Google has a hypothetical market cap of 100 million and a debt of 25 million outstanding today. And its cost of equity is 10%, cost of debt is 6%, and interest tax rate that it gets is 40%. So then the question is, what is unlevered cost of capital and what is weighted average cost of capital for the company Google? And we can do this with plugging in the formula. We know the first step is to calculate the return expectation. The return expectation for this equity and debt combination would be the weighted of the return of equity and return on debt, and you get 9.2%, right? 100 is the total market cap, so it's a total equity, and the total debt is debt plus equity is 125. So if you were to do full equity financing, you would go with this, right? And so now weighted average cost of capital is when comes in when you introduce some sort of tax benefits to it. And when you do that, you get weighted average cost of capital of 8.72. So if you go all equity, your expectation from your investor would be it returns 9.2%. But if you did it with the debt that you have outstanding as a firm and you raise some debt as well, then the expectation goes down because you get some tax benefit for the 40% tax that you pay, right? So take another example. Let's say Facebook has a debt of 240 million, equity of 960 million, risk-free rate in the market is 4%, and market premium is 5%. With beta of equity beta of equity of 0.7 and beta of debt is 0. What is Facebook's cost of capital? How do you do that? What's cost of capital? Cost of capital basically is the CAPM formula, right? And the key thing that you need in the CAPM formula is beta. So first you need to calculate beta. So step one is to calculate beta. How do you calculate beta of Facebook? Facebook has debt and equity, and so its beta of Facebook would be a weighted of debt and equity. So you look at equity, you weight that by beta of equity, you get Facebook's equity weighted, you get the beta of the company overall is 0.56. So take a look, equity beta is 0.7, but the company beta overall is lower because it has some sort of debt, right? So now we got beta, and so now we can plug that into cost of capital, and we can get the return that which is cost of capital that Facebook expects, right? So from beta of 0.56 we get a return of 6.8%. So the investors are going to expect a return of 6.8% even when we know that Facebook investors would expect 6.8%. So that's the cost of capital for Facebook, right? Based on its current debt and equity. We can also calculate. Now the question is, so does that mean that Facebook should be like borrowing more, right? Because it we just reduced the rate to 6.8%, right? So now let's look at this, right? So we knew this formula, right, which is the weighted average formula. So in a sense, Facebook requires 7.5% equity funding expectation and 4% debt funding. But if it used the combined weight, then it would only expect 6.8%, right? So now if you were to, then the question is, should just Facebook just keep borrowing more, because then its expectation cost of capital is going down. So if it borrows more, we can quickly find out that, hey, if Facebook were to borrow more, then what would happen, right? If Facebook were to borrow more, and so how did I get this 7.5 and 4%? So that's the question, right? So let's look at, so one way to calculate the cost of capital is through the CAPM formula, but the other way is to calculate the cost of capital through the weighted formula here. So you can calculate the expectation of equity return on cost of capital would be RF plus beta of equity minus market premium times market premium. So we get beta of we get expected return on equity as 7.5%, and similarly we can get expected return on debt as 4%. And if we weight them and average them together, we get Facebook's overall expected return to be 6.8%, or cost of capital to be 6.8%. So it actually went down, right? So if Facebook were to borrow more, then what would happen? If Facebook were to borrow more, so we know this formula, right? Beta of an asset equals weighted average beta of equity, weighted average beta of debt. The same equation can be written as beta of equity equals beta of asset plus D over E, beta of asset minus beta of debt. And so I've given this formula at the very, I've proved that this is the same formula in this right hand side. I'm not going to go into that, but basically you can rewrite this simple formula to this. So now if Facebook were to raise its debt to equity and make it equal, right? Currently it has debt of 240 and equity of 960, right? But if we were to make it equal and borrow more, such that the debt to equity ratio becomes 1, then we can quickly see that beta of equity actually shoots up. Beta of equity goes from 7.5% right here to almost actually beta of equity goes from 0.7 right here to 1.12. So beta of equity actually went up. That means that Facebook's equity got more riskier because they started borrowing more money. So it went from zero point 0.7 to 1.12. So if you borrow more money, it doesn't come for cheap. That return expectation from equity goes up. So that's the key insight. Although the weighted average cost of capital remains the same, which we can imagine because it just shifts the weight from debt to equity. And so the other interesting parts is taxes, which we saw earlier, right? Like taxes as an important part. So given a company's investment cash flows, it will be used either in equity serving, debt serving, or paying taxes. And when that happens, you can actually deduct the interest that you pay on taxes on your loan with your taxes, right? So two different things, right? So if you have tax that you owe, you can use your interest and deduct that. But if you have cash, right, and then that's like negative debt. So let's look at what debt does, right? So with debt, we just saw that, hey, it helps reduce your tax liability, but it introduces bankruptcy risk. But it also makes your equity look more riskier. We saw in the Facebook example above. Similarly, cash does an opposite effect. It makes your equity look less riskier, right? So even though it's not that good, if you have cash on hand, like let's say Google, Microsoft, Berkshire Hathaway, all of them have lots of cash on hand. So their beta will look better, but it's actually not that good. So let's take an example where we have a company, this one. So let's say Google has 350 billion, 35 billion cash and 200 billion assets, zero debt, doesn't have debt. Its beta of equity is 1.1. But if you actually look at Google's beta without just operations, like beta of operations, and if you take out the cash component from it, you will see beta is actually 1.33 and not 1.1. And the way you do that is you subtract the cash that you have, just look at the operations value, and then you can get the beta adjusted. So basically, even within your firm, you can have multiple divisions, multiple departments. Each one of them have their own beta, and it might be worth it to find out like what is the real beta of a company, and cash actually makes it look really good compared to what it is. So to wrap up with this last example, so let's say now you have a project that you in a company that, and your company does, let's say, software, and you're trying to get into hardware. It's a completely new project, and you have no idea what beta to use, what discount rate to use, what cost of capital to use. So the way you do that is you look at companies that are nearby, right? And if you were to get into a project, let's say Amazon tries to get into an investment project to build a watershed. Like Amazon doesn't do watershed, but it does, let's say, try to do that. And it sees that the opportunity of cash flows is 800 million cash flow generation. And it sees that, hey, watershed industry has a beta of 0.4. Amazon's beta is 2.7, and market cap of Amazon 8.82 billion, and risk-free market return is 6%. Risk premium is 6%, and risk-free rate is 4%. So then how much should Amazon invest? Then Amazon should invest based on what's return is expecting, right? So what is the return that it expects? It expects a risk-free rate plus beta of watershed times the 6% market premium. So it expects that this project will generate 6.4, the cost of capital for this project is 6.4%. And so if it generates 800 million over 6.4%, then it should be willing to pay $12.5 billion. So present value of a cash flow of 800 million for a 6.4% cost of capital would be 12.5 billion. So what happens if Amazon were to take this opportunity and actually invest in this project? Let's say it did invest in this project. Then what is Amazon's new beta? So the current beta is 2.7. What is Amazon's new beta? So you can again weight average that. Amazon's new beta would be the current market cap plus weight average the current beta versus the new project weight average. So the new project's beta actually reduces. So it goes from 2.7 down to 2.4. So that's what happens when you add projects that are actually better for your bottom line. and your beta actually reduces. That means your systemic risk actually went down. So those are the summaries. But and I think there's this one last section actually, which is if you have a new initiative completely, like Amazon and Watershed, you use a comparable firm, and there are 3 steps to it. Generic 3 steps. First is you want to find out an unlevered beta, right? And the way we do unlevered beta is, as we saw earlier, we do weighted average. Once you do unlevered beta calculation, and you find out the comparable firms, to find out like, hey, which comparable firms are there that are doing a similar project that I'm trying to invest in, and then you find out their unlevered beta. Once you find out their unlevered beta, you find out like what is your risk-free rate, and that is step 2. And that typically you can do using a government bond yield, and that'll be your RF. Then the final thing that you need to do is you need to find out cost of capital for your equity. And the way you do that is you do using this formula: beta of equity is beta of assets, D by E, beta assets minus beta of debt, right? So the way you do that, we saw this formula earlier as well, where we proved how we can convert this formula to this formula. And once you do that, you can get the beta of equity. Once you get beta of equity, and the reason why you do this is because you are trying to raise project investment through equity and debt financing, let's say 70-30. So once you have clarity on which firm is a comparable beta to use, once you have the risk-free rate, and then when you have the beta of your current equity of your current project, then you can easily plug that into the CAPM model and calculate the weighted average, right? So you have the cost of equity, right? We just calculated that. We know the debt and equity ratio, we know the tax percentage, and we can easily calculate like what is the weighted average cost of capital for this new investment that you're trying to get in. A lot of this looks quite straightforward in some sense once you know the steps, but it's also an art in some sense, right? There are, as we saw, there's like standard errors, and so historical data is backward looking. So you'd have to there's a lot of new things that you'd have to factor in terms of what are the future orders, how's the company actually doing now, how's the investment actually working. So historical data, the better way to do is with beta, and even better is to factor like future looking things in to find out like what is your real cost of capital. Thanks.